Perfect, perfect. All right, so yeah, let's get started. So maybe first I'll tell you a bit about what we're going to cover and a bit about myself. So in terms of a bit about myself, as Brandon kind of mentioned, I spent some time in investment banking and a bit in private equity. And after my stint there, I started finance interview coach because I actually found that I'm a very entrepreneurial person. And then rather than doing your traditional MBA stint, I actually really, really enjoy kind of teaching the fundamental concepts of finance, financial modeling. And I found nobody else was really doing this. Nobody had created a course or anything like that. So I kind of created my own course for private equity, for corporate development, investment banking, putting together a list of case studies that are quite complex, but also kind of slide decks like the ones we're going to go through today, and for investment banking. And also I've put together a textbook of 300 plus questions and answers. And in case you guys want to know what that looks like, it kind of looks like, oh, I guess you can't see the screen. But anyways, feel free to check out my website to take a look at that book because it is basically questions and answers that have been asked in real investment banking interviews that have been kind of collected over about a decade or so. So we're talking about, the hardest questions we could that have ever been asked throughout those 10 years within kind of the alumni base of the investment club. And so yeah, really valuable resource that I'm offering as well for 120 or 90 US. And in terms of finance coaching, I do that for one kind of 100 and 50 US or $190 per hour in terms of the coaching, helping with financial modeling, or maybe helping out with anything that you're kind of working on. So, or preparing for. So that's my spiel. Thanks for listening to that. Let's jump into some of the exciting stuff today we'll be covering. So enterprise value. So, and Brandon, I just want to take a step back here. Is everybody here kind of like pretty caught up to speed on enterprise value and comps and DCF, or are they still learning these concepts?
Yeah, so I think it's a mixture of things. So I think the people on the call are a mix of first, second, and third years. And then, yeah, so I think most people understand the basics.
Okay. Got it. So I'm gonna whip through the basics a lot quicker, so we have more time on the more exciting topics. I'm hoping to cover very, very basic M&A and LBO today. I know it's a lot in a short period of time, but I'm gonna try to teach very efficiently because I find if I focus too long on one topic, there's a good percentage of the class I might not learn anything. So we're just gonna race through here. And you guys have the slides, I believe, so you can always review. Okay, let's go through it then. Enterprise value. What is enterprise value? It's basically the value of the firm. And you've probably learned that maybe in class. And this is the full formula, but if we were to simplify this real quick, how much is a company worth? Well, it's worth how much money's been put in, right? Or what people are valuing it as, right? So the market cap, that's the stock market. That's like shares times stock, shares to price times total shares. This will move with the market, right? That's the equity side. Then you have your debt side, which represents the part of your business that's funded by debt. And we subtract cash. Now the question is, why do we subtract cash? Well, you think about it as buying a piggy bank, right? If you're gonna buy a $20 piggy bank with $5 of cash in it, you may as well say to the person, well, geez, I'll just give you 15 bucks and you keep the five, right? There's no point buying cash with cash. So we deduct the cash. You can also use cash to pay down debt. So that's why we deduct cash. Now, that's a simple formula. Let's take a look at the more complicated formula. Okay, what did I do here? I added in preferred equity. Oops, sorry. What's preferred equity? It's similar to debt. It pays dividends, but these dividends have to be paid before like the common shareholders. So in a way, they're sort of like earning interest because it's almost guaranteed. It's like a regular payment. So yeah, it's basically debt. It's a way to take on debt without actually calling it debt for companies. Sometimes they just want to avoid that term. Or no, debt we talked about now. What about minority interest? Common interview question. Why do we add back minority interest? Well, okay, if a company owns more than 75% of a subsidiary, they must consolidate. What does that mean? When I say consolidate, I mean they're like Ebitda, their income statement. So like, even though we own 75%, we have to act like we own 100% of their Ebitda. So, okay, what happens then? Well, if we do a very common multiple called enterprise value over Ebitda, what's the problem? The denominator has 100% of the subsidiary, but the numerator only has 75%. Why is that? Because the stockholders, they only care about the part of the company you own, which is the 75% that you own. But in order to make this multiple work, there's a very common enterprise value over EBITDA. The numerator has to match the denominator in terms of units. So we're actually going to add back the part of the company we don't own. It's called minority interest. It's actually a line on the balance sheet. So we add that in. And then that way, this will be apples to apples. This will then after include 100% of the subsidiary. So in long story short, this is all just to undo what accountants do, which is like 80% of finance. But yeah, that's minority interest. Okay, another common question. Capital lease versus operating lease. Which one has a higher EV over EBITDA? Well, what does that mean? A capital lease, what does that mean? Like let's say you have a car. You want to buy a car. Actually, hold on. I want to take a step back. Am I going at the right pace so far, Brent? Like, is everybody kind of catching along? Because I know it's pretty fast.
Yeah, I mean, if you guys have any questions or want to slow down, just mention in the chat. But I think it's good so far. But...
Yeah, exactly. Mention in chat, and then Brandon, if you see questions, just feel free to just interrupt me and that kind of thing.
I think people are saying the pace is good so far. So.
Okay, awesome. So everybody's following along. Good. Okay, so back to capital leases. Let's say you're leasing a car for 15 years. By the end of 15 years, your car is basically yours. Like it's so it's basically like ownership. So it's like taking debt and payments. You're really just paying interest and principal. Interest and principal are below EBITDA, right? So EBITDA is going to be higher because we don't have to pay any expense. It's just interest. And as a result, EBITDA being in the denominator, EBITDA is going to be lower. What about operating lease? Operating lease is more like rent. So it's an expense. So the expense goes above EBITDA. So therefore, EBITDA is lower, and the EV over EBITDA multiple is higher. Great. Yeah, and just like random note, capital leases and pension obligations are treated as debt. In enterprise value, long-term investments and investment associates are kind of treated as cash, because like in a way you could theoretically sell these investments and use it to pay back debt. Okay. Multiples. What are multiples? Why do we care about multiples? Multiples, it's like buying a house, right? When you buy a house, real estate, how do we value real estate? We think price per square foot. It's like, what am I getting for my money? Well, I'm getting square feet of real estate. Same thing with stocks or companies. Whoops, sorry. Let's start with PE. PE is the most easy to understand. Price, stock price divided by the earnings. You're going to pay X amount of money for a stock, and you're going to get X amount of earnings. Like earnings per share type thing. Yeah. So now, bankers prefer this multiple, enterprise value over EBITDA. Why? Well, price over earnings is only accounting for equity. Like there's no debt here, it's just equity. But enterprise value, as we mentioned, has both the equity and the debt. And EBITDA is the return to both debt and equity holders. And why else do we prefer it? Well, think about EBITDA. EBITDA is a really nice number. Why? It is before interest. Therefore it's capital structure neutral, right? So, whoops, sorry. So before interest, the I there, capital structure neutral. Before the T, so tax jurisdiction neutral. Before the depreciation and amortization, so therefore accounting policy neutral. It's neutral to a lot of things. It's also a great proxy for operating cash flow, like the core profitability of the business. Whereas price over earnings, you think about earnings, that's an accounting number. There's so much stuff in there, interest expense. So it'll penalize people for like different capital structures and different tax policies. But accountants also do weird things with earnings, right? It's always like a made up number. So, but that being said, people will use price over earnings for banks, for financial institutions, where interest is a core part of the business, because interest is like almost a cost of goods sold in a way. So you want to make sure the interest expense is being captured for like finance firms. And also traders will use POV because it's just faster. Like you don't have time to calculate EBITDA if you're on the desk.
We just have a question in the chat right now. So the question's about capital leases.
Okay.
So the question says they increase EBITDA, but they also increase enterprise value because they treat it as a debt. So what's the net effect on EV to EBITDA?
Oh, that's a really good point. Yeah, capital leases are kind of treated like debt. And then yeah, and then they result in a higher EBITDA.
So,
Actually,
yes, I think the question is just saying, so what's the net effect on EV to EBITDA, given that they impact
what's the net effect? That's a good question. I've never actually thought of that. That's a really good point. Like, I'm just thinking, like, if I take on 200 debt and I'm paying 10% of 20, like, it's hard to say, right? It's kind of a mathematical fraction thing. Uh, that's actually a good point, but I think for the purpose of interview questions, just don't worry about the increase in debt and just focus on the EBITDA. Because like hypothetically, it doesn't really matter if um, actually it does matter. Yeah, yeah, that's a good point. But I think the interview answer is still the same. I actually never thought about that. So maybe I could think about that. Come back to you guys.
Sounds good.
Okay, cool. Well, a really good question. I mean, it stumped me, to be honest. Okay, so I still, but for the purpose of interviews, like just go with what I wrote, but I can try to come up with a theoretical answer to what was just asked maybe later when I'm thinking on my own and on fresher. Okay, so let's keep moving though. Really smart questions. I love these. Awesome. So multiples. Let me make a note actually to note capital leases. Okay, great. Okay, let's jump back. Okay, so multiples. People care more about the future than the past, right? A stock is worth its future cash flows. So when we can, we use next 12 months, but we'll use last 12 months. Last 12 months meaning like, enterprise value over last year's EBITDA versus like next year's EBITDA. Well, we would use last 12 months when it's a private equity, right? So maybe there aren't any public companies. So we don't know the forecast. So we can only use the historicals in that case. There are a lot of industry specific multiples. If you're applying to a specific group, you got to know them. So energy, you got to know that probably the most important is like EV over production and EV over reserves. I mean, for any resource thing, it's like EV over production, EV over reserves. Why? Well, that's what you're doing. You're producing in these kind of companies. You want to know how much they're producing. You also want to know how many reserves they have. So like in the long run, how many assets can they use? So yeah, lots of different multiples for different industries. Like real estate has this like adjusted FFO thing, which you can read about if you like. So yeah, all interesting. Like financial institutions, they'll often use POVE or price over book. Anyway, so let's move on. Okay, so comps, basically the way comps works is you figure out a bunch of companies that are similar, you find their median EV over EBITDA, and then you apply that EV median multiple to the target company's EBITDA. So like, let's say the median multiple is 10 times in the industry for EV over 2021 EBITDA. I would take that 10 times and multiply by the target's EBITDA. Let's say the target's EBITDA is 10 mil. Well, 10 times 10 is 100. These are kind of really bad made up numbers, but that was a quick example. Okay, so Treasury stock method. This is what is used to calculate fully diluted shares outstanding. Okay, so now the common shares were given usually on the 10K or the annual report, but there are often options that are granted, and some of these will have a strike price that's lower than the stock price, meaning that you have the right to buy the stock at a lower price than it actually is. So you'd obviously want to buy it, right? Because it's like cheaper than it actually is. So we're going to assume that anybody with options that are in the money, quote unquote, are going to exercise them because they're profitable. So that once they're exercised, well, these people are basically exercising their right to buy a stock. They still have to buy it. They still have to pay as cash. It may not be as much cash as like a normal stock, but still cash. So we're gonna get that cash and we're gonna use the cash to buy back shares. Why? Well, the academics who built this, they decided